Monday, July 18th, 2022, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at how, in my opinion, the next big crisis will be a run on the currency or a run on the central banks. Yes, normal banks might get into trouble, but the ultimate crisis will be a central banking crisis. And I'm going to reference a very good piece of research by Dan Oliver for that. Before I start, I like to say that, it's very, very hot already today. It's supposed to get into the 40s in terms of Celsius, just above 100 in terms of Fahrenheit. A lot of scaremongering out there in the mainstream media. This has happened before. It's summer, so yes, it's going to be uncomfortable. Billy is a little bit uncomfortable. I've been spraying him with a little bit of water, and we've been out as well. So, yes, in the last crisis we had, big crisis, of course, 08, it was a banking crisis. Of course, it started as a subprime mortgage crisis, and it evolved into a complete collapse of the banking system. And governments and us, the taxpayer, had to bail out the banks. And this is one of the reasons why things are not great for the general public. And I said that back then, that bailing out the banks and letting them keep their profits was a very bad precedent. And they haven't reformed or anything, but the other thing that has been happening under the current fiat currency regime, is that each crisis gets bigger and bigger. And it reminds me, of course, of fiat money inflation in France. Every time there's a crisis, every time there's a slowdown or recession, they have to come in and inflate even more the system. Because if they don't, the system collapses. And eventually the system will collapse. But I have a feeling it will be through the hyperinflationary avenue, and even if it is through a deflationary collapse, things will be really bad, that you will want to have gold and silver. And before I reference Dan Oliver, just like to point out why gold is so important. Well, when you have publications like the FT trying to downgrade gold in an editorial, it's because it's important. You've seen, many of you have seen this. My new subscribers, new viewers haven't. So this is an editorial that I cut out from 2004. And the story is, I was going to work in the city, waiting for the train around 6 a.m. And I used to buy the FT and read it going to work. And I used to like turning to the editorial page, and I saw this, going gold, it says, as you can see. And at the time in 2004, I'd already started accumulating physical gold. I knew that the system was no good already from studying. That's the thing that happens when you buy gold and silver. It opens your mind. It makes you study and see, why do they get rid of this? And you learn, of course. But yes, why is this important? Well, because the FT is the mouthpiece of these people who run the central banks, of the Davos World Economic Forum crowd. And one thing about the Davos crowd is that they want a technocratic world where you and me are just a number. We're not human beings anymore. It's all technocratic. It's a dictatorship. And gold goes against that, because gold gives you freedom, gold and silver. And they want you in their debt-based system. So, yeah, April 16th, 2004, I wrote here, and I said wrote that the price of gold was around $400, and at that time, $400 was a key resistance. So the FT was trying to discourage people, investors, people who read the FT from acquiring gold. It says the pointlessness of holding bullion continues to sink in. I'm not going to go through it. You can read the editorial here. You can pause the video and read through it, but they were wrong about it then, and all the naysayers about gold and silver are wrong now, in my opinion. And why is that? Well, because gold and silver are the anti-technocratic crowd. Technocratic crowd, they want to control you. It's a dictatorship. It's a godless, soulless system, and they will not win because they have never succeeded to do so. Yes, they will try their darndest to do it, but they will not succeed. So let's look at what Dan Oliver talks about. And I'm going to put a link to his article below in the description, and you can go through the whole thing. One interesting thing he talks about is that when the Federal Reserve started operating, when it was created, it was legislated into law, the Federal Reserve System, on December 23rd, 1913, but it started running in 1914. If you look at this chart, it says the Federal Reserve issues liabilities against assets that are ever more illiquid. So that's how a bank works. It buys assets to cover its liabilities towards the banking system. That in the case of the Fed. In the case of normal banks, it's the liabilities the banks have towards the public that holds accounts with them. But as you can see here, when the Fed started, most of its assets were gold and commercial bills. There is very little treasury bonds, as you can see. So commercial bills are really interesting. They're usually 1 month or 3 month discount bills. And it's based on real economic activity. So let's say there's a shipping or a company that has a 3 month discount bill for, let's say, a shipment of oil that's coming. So it's based on real things. It's not created out of thin air. It's mostly paper now, promises, mortgage-backed securities. Of course, the real estate market is not that liquid. It's not as liquid as gold. It's not as liquid as commercial paper. And treasury bonds, not liquid either. Yes, they can be borrowed out of thin air by the Treasury and bought by the Fed out of thin air, but they really are not backed by anything. So the Fed's balance sheet, the quality of it is pretty bad now, and that's where the bank runs come in. So this is what Dan Oliver says here. Modern economists assume that central banks' asset value and cash flow position have no bearing on the value of its currency. Murmichan disagrees. Pre-1933, central banks could and did experience runs. Institutions and individuals could go to the central banks and demand redemption of currency into gold. They can no longer do that, but they still can run to the coin shop and convert currency into gold. That is what happened in 1980 as gold ran past $650 per troy ounce. The gold on the Fed's balance sheet completely backed its liabilities. This phenomenon is going to happen again. The chart below demonstrates that our system of economy and finance are unsustainable. It's actually worse than the chart suggests because GDP is a measure of activity, not wealth. And much activity in the bubble economy is non-productive. Sometimes it even destroys value. So the other thing I would add to that is that GDP adds government spending, which is like non-wealth producing as well, is actually it's like double counting because it takes wealth from the productive private sector. So yeah, and he goes on to say the manic growth of credit compared to wealth has occurred only because the Fed has been willing to impair its own balance sheet, as shown by the two previous charts. It says here, in 1958, economist Melchior Pillai, advisor to the post-hyperinflation Reichsbank, warned Americans not to follow the German path. And this is what he said. When the national credit and the national currency are tapped in order to maintain full employment might be maintained. The money market can be kept liquid indefinitely if the Treasury prints certificates and the Federal Reserve monetizes them. But what happens to the liquidity of the monetizer? So there you go. That's how we have to look at gold and silver as well. And I think silver will outperform gold in terms of what it will be able to purchase when this run on the central banks happen. And he talks about prices here. He goes on to say, when the world loses confidence in the Western banking system, perhaps as soon as this winter, when Europe will face economic and political collapse because of the conflict with Russia, the Fed will be forced to print more and faster, and there will be runs on central banks. There are no liquid assets on these balance sheets that can be sold to support the currency. While they do have gold on their balance sheets, and it's still valued, the Federal Reserve's gold certificate, at $42.22. He goes on to say gold will trade at a price that balances central bank balance sheet. In order for gold to back the Fed's liability by a modest 1/3, it would currently require a price above $11,000. Since markets always overshoot, $17,000 or half backing is a more reasonable target. The peak price in 1980 resulted in an absurd 133% backing, which today would translate to 45,000 ounces. This assumes no growth in the Fed's balance sheet. So, and that's why the central banks, through the bullion banks, through the LBMA, through COMEX, the futures, that's why they manage the price of gold with paper. But once that paper loses all credibility, they won't be able to do it anymore. And you won't be able to obtain any gold and silver. I think Mike Maloney calls it unobtainium, something like that. And so there you go. The quality of the balance sheet of the central banks. That's what it's all about. The quality of the assets that they hold. And it's the same thing for individuals. You don't want to be holding crappy assets. You want to be holding the assets, the money of king and king's gold, and the money of gentlemen silver, and I guess some hard assets outside the system. You might want to be in the system, of course, which I am partly, not a huge proportion in the mining sector. And he talks about mining sector as well, and gives his opinion on it. So let's look at where the markets are this morning before it gets too hot here in London. It's 8:15 a.m. London time. We've got spot gold, the paper price. So the central bankers still have control of it. It's at 17.16. It's up about $8. High's been 17.19, low 17.05. So it's up 0.5%. Silver is up about just under 1% at 18.86. Has been as high as 18.94 and as low as 18.63. Yes, we go through the spot price or paper price every day or during the week. only to really give you an indication where things are. But as you heard earlier today, the important thing is an insurance policy. It's real money. And yes, you might want to trade paper gold and paper silver, but that's a different story. And I've done it before, but I found it it could be something that you regret unless you have the physical on the side. Yeah, never trade your physical, I would say. Only when things reset, when there's a run and the true value of gold and silver come to the fore, then you can exchange it for assets that you want to acquire, which are really a little bit too overvalued still right now. Dow futures is up 175, or just over 0.5%, 31,450. Nasdaq is up 107, up just under 1%. And the S&P 500 is up 26, 2/3% at 38.88. The FTSE is up 72, or 1% at 72.40. Eurostoxx 50 is up 31 points at 35.06. To the currencies, sterling is up 0.5%, 119.30. The euro is up 0.5% as well at 101.38. The dollar is down 0.2 versus the yen at 138.21. Dollar is down slightly versus the Swiss franc, 97.50. Dollar is down slightly versus the yuan at 6.75. Let's check the ruble. The dollar's at 57.50. It's actually up about 4% versus the ruble, the dollar. To the other currencies, we've got the Aussie dollar up 0.5% at 68.25. We've got the dollar down 1/3 versus the Canadian dollar, 129.78. And the Kiwi dollar is up 0.2 at 61.70. To the general commodities, WTI crude is up just over 2%, 97.05. Brent crude is up 2.5% at 101.20. And high-grade copper is up 2.3% at 331. U.S. nat gas is back above 7. It's up almost 2% at 708. To finish off, let's look at the 10-year yield and the U.S. Treasury yield curve. The 10-year yield is at 295. It's up 2 basis points. The 2-year is up just under 2 basis points at 315. So basically, the curve is inverted by 20 basis points, which is signaling more than ever that we're going to get a recession very soon, I would say. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And yes, I wish you all a great day and a great start to the week. Take care. Bye.